Most people come into trading believing one simple idea: if I can just find a good enough strategy, success is guaranteed. They imagine that somewhere out there is a perfect setup, a flawless indicator, or a secret combination of rules that turns trading into a predictable money machine. And to be fair, that belief makes sense. In almost every other area of life, having a good plan usually leads to good results. Study the right material, follow the steps, apply the formula, and improvement follows. So naturally, new traders assume trading works the same way. But here's the uncomfortable truth. Many traders fail even while using sound, well-tested strategies. Strategies that are objectively profitable on paper. Strategies with real statistical edges. Strategies that should work. Yet somehow, the account still bleeds. Confidence erodes, frustration builds, and eventually, the trader either quits or jumps to the next better system, convinced the problem must be the strategy itself. This video exists to challenge that assumption. Not to say strategies don't matter, but to explain why they are only a small piece of a much larger puzzle. Because trading is one of the few skill-based activities where knowing what to do is not the same as being able to do it consistently. The gap between theory and execution is where most traders lose. What we're going to break down is why a good strategy doesn't guarantee success, and more importantly, what actually causes traders to fail even when the strategy itself is not the problem. We'll talk about execution mistakes, risk management errors, psychological pressure, discipline, expectations, and the hidden forces that quietly destroy performance over time. By the end, the goal isn't just to make you a better trader, it's to help you stop blaming the wrong thing and start focusing on what truly determines long-term survival and profitability in the markets. Before we can understand why traders fail, we need to redefine what a good strategy actually is, because this is where most people go wrong. A good strategy does not mean certainty. It does not mean every trade works. It does not mean smooth upward equity curves with no drawdowns. In reality, a good strategy is simply one that has an edge, a small, measurable advantage that plays out over a large sample size. That's it. Nothing more. Nothing magical. An edge means that over many trades, the average outcome is positive. But in the short term, anything can happen. You can take 5 perfect trades in a row and lose on all of them. You can follow every rule flawlessly and still experience a brutal drawdown. And this is where traders start doubting themselves. They confuse randomness with failure. They assume losses mean something is broken, when in reality, losses are often just the cost of doing business. The market operates on probabilities, not guarantees. Each individual trade is statistically insignificant on its own. It's only when trades are taken consistently, under the same conditions, with the same risk parameters, that the edge reveals itself. This creates a psychological problem. Humans are wired to seek immediate feedback and cause and effect relationships, but trading doesn't reward that mindset. You can do everything right and still lose, and you can do everything wrong and still win. In the short term, outcomes lie. This disconnect between expectation and reality is dangerous. Traders expect a strategy to protect them from uncertainty, when in fact the strategy exposes them to it. The real job of a trader is not to predict the next move, but to repeatedly execute a statistical advantage while emotionally surviving the randomness in between. Most people underestimate how hard that actually is. So when someone says, "This strategy doesn't work," what they often mean is, "This strategy didn't give me immediate confirmation." A good strategy is boring. It's repetitive. It feels uncomfortable during losing streaks and underwhelming during wins. And unless a trader truly understands this, unless they accept that success comes from long-term expectancy, not short-term validation, they will constantly sabotage themselves before the edge ever has a chance to play out. Even the best strategy is worthless if it isn't executed properly, and this is where reality starts to clash with theory. On paper, rules look simple. Enter here, exit there, manage risk consistently. But in live markets, execution becomes emotional, reactive, and inconsistent. Small deviations begin to creep in, and over time, Those small mistakes compound into massive performance gaps. One of the most common execution errors is deviating from the rules. A trader sees a valid setup but hesitates because the last trade lost. Or they take a setup that almost meets the criteria because it looks good enough. These tiny compromises feel harmless in the moment, but they slowly erode the edge. The strategy no longer behaves like it did in testing because the trader is no longer trading the strategy. They're trading their emotions. Hesitation is another silent killer. The setup appears, the conditions are met, but fear steps in. The trader waits for extra confirmation, and by the time they enter, price has already moved. Now the risk to reward is worse, stops are tighter, and the trade fails, not because the strategy didn't work, but because execution was late. Ironically, this reinforces the trader's fear, creating a vicious loop of hesitation and regret. Inconsistent exits cause just as much damage. Some trades are cut early to protect profits, while others are held too long in the hope they'll come back. Winners get clipped. Losers are allowed to grow. Over time, this flips the entire expectancy of the system. A strategy designed to let winners run and cut losses quickly becomes the opposite, simply because the trader couldn't stick to predefined exit rules under pressure. What makes poor execution so dangerous is that it's hard to see. Traders blame market conditions, bad luck, or the strategy itself, without realizing that they are introducing randomness where structure is required. Consistency is the bridge between strategy and results, and most traders never cross it. They underestimate how disciplined execution, trade after trade, is far more important than finding a slightly better setup. If execution is the bridge between strategy and results, risk management is the foundation everything rests on. And just like a building with a weak foundation, no matter how good the design looks, it eventually collapses. Many traders talk about risk management, but very few truly respect it, especially when emotions get involved. One of the most destructive mistakes traders make is oversizing positions. After a few wins, confidence rises. The trader feels in sync with the market and decides to increase size to maximize profits. On the surface, it seems logical, but when the inevitable losing trade or losing streak hits, the damage is amplified. What should have been a manageable drawdown becomes a psychological crisis. Fear replaces logic, and decision-making deteriorates fast. Ignoring drawdowns is another critical error. Every profitable system experiences periods of underperformance, but traders often treat drawdowns as personal failures instead of statistical realities. Instead of adjusting emotionally and sticking to the plan, they try to make it back quickly. This usually leads to revenge trading, looser criteria, and higher risk per trade, turning a normal drawdown into a catastrophic one. Inconsistent risk per trade is more subtle, but just as dangerous. Some trades risk 0.5%, others 2%, others whatever feels right. This randomness destroys the mathematical structure of the strategy. Even with a positive edge, inconsistent risk creates unpredictable outcomes, making it impossible to evaluate performance accurately. The trader feels like results are chaotic, when in reality, they made them chaotic. Proper risk management isn't about avoiding losses, it's about surviving them. Losses are inevitable. What matters is how much damage each one can do, both financially and psychologically. When risk is controlled, losses stay small, confidence stays intact, and execution remains stable. When risk is ignored, every trade becomes emotionally loaded, and the strategy never gets a fair chance to work. Psychological pressure is the invisible weight that sits on every trading decision. It doesn't show up on charts, it isn't measured by indicators, and it doesn't care how good your strategy is. Under pressure, even the most logical trader can act irrationally, and most traders dramatically underestimate how much mental stress trading creates. Fear of losses is usually the first emotion to surface. After a string of losing trades, fear creeps in quietly. The trader starts second-guessing entries, tightening stops prematurely, or avoiding valid setups altogether. Every trade feels like a threat rather than an opportunity. Ironically, this fear often causes the trader to miss the very trades that would have recovered the drawdown, reinforcing the belief that nothing works anymore. Then there's greed, often disguised as confidence. After a winning streak, traders feel invincible. Rules start to feel optional. Risk increases. Targets are ignored in favor of just a little more. Greed convinces the trader that this time is different, that they've finally figured it out. And just like that, one oversized loss wipes out days or weeks of progress. The most dangerous moments come when decisions are made under stress. Maybe the trader is already down for the day. Maybe they're trying to hit a daily goal. Maybe external pressure, bills, expectations, or comparison to others is weighing on them. In these moments, trading stops being analytical and becomes emotional. Trades are taken to feel relief, excitement, or validation, rather than because they meet the criteria. What makes psychological pressure so difficult is that it compounds. One emotional decision leads to another. A small mistake triggers frustration. Frustration leads to impulsive trades. Impulsive trades lead to bigger losses. And before the trader realizes what's happening, they're no longer following a strategy at all. They're reacting. This is why trading psychology isn't about controlling emotions. Emotions will always be there. The real skill is learning to operate despite them, by having structure, limits, and rules that protect you when your mind is working against you. Overtrading rarely starts as a conscious decision. It usually begins as a reaction: boredom, frustration, impatience, or the need to feel in control. The trader sits in front of the screen, watching price move, feeling like they should be doing something. And in that moment, discipline starts to slip. One of the most common causes of overtrading is trading out of boredom. Markets don't offer high-quality opportunities all the time, but many traders expect constant action. When nothing is setting up, they lower their standards. They convince themselves that a mediocre setup is close enough. After all, sitting on the sidelines feels unproductive, even though it's often the most profitable decision. Frustration is another powerful driver. After a loss or missed trade, the urge to get back into the market becomes overwhelming. The trader wants to make the pain go away, so they force a trade that doesn't meet their criteria, hoping for a quick win to restore confidence. Instead, they often take another loss, deepening the emotional spiral. Overtrading also destroys an edge through frequency. A strategy is designed to work under specific conditions, not on every price movement. When traders increase the number of trades beyond what the strategy was built for, they dilute its effectiveness. Transaction costs rise, focus drops, decision fatigue sets in. What once was a sharp, selective approach becomes noise-driven gambling. The worst part? Overtrading feels justified in the moment. The trader tells themselves they're being active, aggressive, or hardworking, but in reality, they're avoiding patience. They're trying to force profits instead of letting them emerge naturally. Over time, this behavior trains the brain to associate trading with constant stimulation rather than disciplined waiting. Profitable trading is often boring. It requires long stretches of doing nothing, followed by brief moments of precise execution. Most traders fail not because they can't trade, but because they can't wait. Discipline isn't about willpower in the moment. It's about structure built in advance. And this is where many traders fall short. They approach trading reactively, without a consistent routine, expecting themselves to just make good decisions when the pressure is on. But without structure, discipline collapses the moment emotions enter the picture. A major issue is the absence of a clear, structured trading plan. Many traders have rules in their head, but not on paper. Entries are vaguely defined. Exits are flexible. Risk rules are conditional. This ambiguity leaves room for interpretation, and interpretation is where emotion sneaks in. When results start to slip, the trader doesn't know whether the problem is the strategy, execution, or market conditions, because nothing is clearly defined. Inconsistent preparation is another hidden weakness. Some days the trader analyzes the market thoroughly. Other days they jump straight in, reacting to price without context. This inconsistency leads to inconsistent results, which then erodes confidence. Without proper preparation, trades feel uncertain before they even begin, making it easier to panic or exit early. Just as damaging is the failure to review and track performance. Many traders avoid journaling because it forces them to confront their mistakes. But without data, progress is impossible. Patterns go unnoticed. Emotional leaks remain hidden. The trader keeps repeating the same errors, convinced the issue lies somewhere else. What isn't measured can't be improved. Routine creates stability in an unstable environment. When a trader follows the same process every day, pre-market preparation, execution rules, post-trade review, it reduces emotional load. Decisions become mechanical. Confidence comes not from wins, but from consistency. Without routine, every trading day feels different, and that unpredictability feeds stress and impulsive behavior. Discipline is not something you summon when things go wrong. It's something you build when things are calm, so it's there when they're not. Losing streaks are one of the most misunderstood and feared parts of trading. Most traders intellectually know that losses are part of the game, but emotionally, they experience losing streaks as proof that something is wrong. That disconnect causes panic, self-doubt, and ultimately, self-sabotage. In any profitable system, losing streaks are normal. They're not a sign of failure, they're a statistical certainty. Even strategies with strong win rates can experience multiple losses in a row. But when traders aren't prepared for this reality, each loss feels heavier than the last. Confidence erodes, and the trader starts questioning decisions that were previously executed without hesitation. This often leads to abandoning strategies too early. After a few losses, the trader decides the strategy stopped working. They tweak rules, change indicators, or scrap the system entirely, usually right before the edge reasserts itself. The irony is painful. Many traders leave right at the worst possible moment, locking in losses and missing the recovery. Strategy hopping becomes a coping mechanism. Instead of sitting through discomfort, the trader looks for relief in something new, a different market, a different time frame, a different system promising smoother results. But the same cycle repeats, because the core issue isn't the strategy, it's the inability to tolerate variance. Over time, this prevents any meaningful statistical edge from ever playing out. What traders fail to realize is that consistency through losing streaks is what creates profitability. Anyone can follow rules when things are going well. The real test is sticking to the process when it feels pointless, uncomfortable, and unrewarding. That's where most people quit, and that's exactly why so few succeed. Understanding drawdowns and losing streaks ahead of time, expecting them, planning for them, and emotionally accepting them changes everything. Losses stop being personal. They become data. Even when a trader has a solid strategy, good execution, and decent discipline, external noise can slowly poison their confidence. The modern trading environment is loud. Constant opinions, charts, alerts, and bold claims flooding social media every single day. And without realizing it, traders begin to outsource their conviction. One of the biggest problems is listening to too many other traders. You take a trade based on your plan, then scroll through social media and see someone calling the opposite direction with complete confidence. Doubt creeps in. You start questioning your analysis mid-trade. Maybe you move your stop. Maybe you exit early. Maybe you flip your bias entirely. The trade becomes emotionally unstable, not because the setup changed, but because your belief did. Conflicting signals create paralysis. One indicator says buy, another says sell. One trader is bullish, another is screaming crash. Instead of trusting a single tested process, the trader tries to reconcile all the information at once. This leads to hesitation, late entries, or no action at all. Too much information doesn't create clarity. It destroys it. Over time, constant exposure to external opinions leads to loss of confidence in one's own process. The trader stops believing in their edge and starts chasing validation. They measure success by whether others agree with them, not by whether they followed their rules. This dependency makes consistent execution nearly impossible because the trader's mindset is always shifting. Successful traders limit their inputs. They deliberately reduce noise. They understand that clarity comes from simplicity and repetition, not constant stimulation. The more voices you let into your decision-making, the weaker your decisions become. At the core of many trading failures is a simple but dangerous problem: expectations that don't match reality. Most traders don't fail because they lack intelligence or effort. They fail because they expect trading to reward them faster, smoother, and more consistently than it actually does. Unrealistic profit goals are a major culprit. New traders often enter the market expecting rapid growth, doubling accounts, making consistent daily income, or replacing a full-time job within months. When results don't match these expectations, frustration sets in. The trader starts pushing harder, trading more aggressively, and taking unnecessary risks, all in an attempt to force the market to deliver on an unrealistic timeline. Many also underestimate the time and effort required to become competent. Trading is often marketed as a shortcut to freedom, when in reality it's a long-term skill that demands deliberate practice. There are no guarantees, no steady paychecks, and no external validation. Progress is slow, uneven, and often invisible. Without accepting this up front, traders interpret normal struggles as personal failure. Another common mistake is confusing skill development with immediate results. A trader might be learning valuable lessons, improving discipline, refining execution, controlling risk, but still be unprofitable in the short term. Instead of recognizing this as progress, they judge themselves solely by P&L. This narrow focus causes discouragement and impatience, leading them to abandon the very habits that would have paid off over time. When expectations are misaligned, every loss feels unacceptable, every drawdown feels catastrophic, and every slow period feels like wasted time. But when expectations are realistic, losses become manageable, patience becomes possible, and consistency becomes achievable. By now, one thing should be clear. A strategy alone is never the reason a trader succeeds or fails. A strategy is just a framework, a tool. It doesn't execute trades. It doesn't manage risk. It doesn't control emotions. The trader does. And that's why so many people fail while using strategies that are objectively sound. Success in trading comes from the alignment of multiple components working together. Execution must be consistent. Risk must be controlled. Psychology must be managed. Discipline must be built through routine. Expectations must match reality. When even one of these elements is weak, it puts pressure on everything else. And under that pressure, traders break their own rules, then blame the strategy for the damage they caused themselves. The hard truth is that trading isn't a shortcut. It's a process, a long one. Progress doesn't come from finding something new, but from doing the same simple things correctly, over and over, especially when it's uncomfortable. Profitable traders aren't smarter or luckier. They're just more consistent under uncertainty. If you reframe trading this way, everything changes. Losses stop being enemies and start becoming data. Drawdowns stop being crises and become expected phases. Confidence stops coming from outcomes and starts coming from execution. And the strategy, once blamed for everything, finally gets the chance to do what it was always meant to do, express its edge over time. So if you're struggling, don't ask, what strategy should I use? Ask instead, can I execute one strategy well with discipline, patience, and respect for risk? Because in trading, the difference between failure and success is rarely the system. It's the trader behind it.